Hello and welcome to this session. This is Farhat. In this session, we will discuss limitations of ratio analysis. In the prior sessions, we had a series of lectures about various ratios, financial tools that will help you analyze the company's performance. We also looked at vertical analysis, horizontal analysis, in addition to the ratios. And those ratios were the profitability ratios, the activity ratios, liquidity, solvency, EPS, and other ratios as well. And if you remember, we always mentioned that ratios need to be compared to prior period within the company, to industry average, to a competitor. It has to be compared to a benchmark for a ratio to make sense. And this is how we make sense out of them. Now, real quick, why do we use ratios in the first place? Well, we use ratios to make better business decision, formulate plans for the company, whether you are a manager, creditor, investor, supplier. You want to take a look at the ratios in order to make a better decision. In this session, we will be looking at what could impact the quality, the usability of these ratios, the usefulness of these ratios. There are certain things that the ratios will need to be taken with a grain of salt and sometimes with a whole cup of salt, right? And you're going to see why. Because there are factors, and in this session I would list 12 factors. Now, some of these factors are interrelated. Nevertheless, the point is those factors influence the ratios. Influence means not influence it in a good sense. It limits its usefulness. So you have to take into account other things when you are computing these ratios. Now, in the real world, financial statement analysts, who are CFAs that analyze companies, they take into account a lot of factors before they come to a conclusion. So whatever you learn with Farhat lectures or in your finance course or CPA course or CMA course, in the real world, those factors are adjusted and sometimes adjusted tremendously. So in this session, I will show you what are the limitations and why would an analyst in the real world will have to adjust them. And that's why I put those 12 factors are interrelated and they're not inclusive. Those are not everything. There are others that could apply to your industry. Now, bear in mind, we're not saying ratios are useless. That's why we spend 5, 6, 7 sessions on ratios. In this session, we want to highlight the point that you have to use them with caution. You have to consider the context, supplement the ratio with other quantitative and qualitative evaluation to make a better decision. This is the purpose or the point of this session, to look at ratios, then look at ratios again from different context. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello, my name is Farhat. You are here because you are either an accounting student, a finance student, or someone who's studying for their CMA or CPA exam. Great. You are looking for some additional help, and we can help you. I strongly encourage you to visit my website, farhatlectures.com. I offer additional lectures, resources, including PowerPoint slides, multiple choice questions, in some circumstances, exercises, and true-false questions. Our material is aligned with your CPA review courses, with your CMA review courses, with your college courses. I offer a risk-free trial that you can try to find out whether my website can help you or not. If you find it helpful, you subscribe, you keep your subscription. If not, you cancel and your risk is free. If you like this recording, if you like my lectures, you would like what's on the website, give me a chance to help you with your college courses as well as professional certification. I hope to see you on the website.
The first limitation that could affect ratios is accounting estimates. Now, some of these reasons you already should know, but I will explain briefly. But this should be a review. This should be like a comprehensive review. One thing is accounting estimate. And what is estimate? Well, if we don't know that accounting numbers rely heavily on estimates, and guess what forms ratios? Accounting numbers. So when we start with the trial balance, from the trial balance, we prepare financial statements such as the income statement, such as the balance sheet, such as the statement of cash flows. Now, from these financial statements, we will prepare the ratios. So going back to the original trial balance where we have the list with the accounts, these accounts with their figures are estimated because accounting rely heavily on estimate. So ratios are also estimates because we use accounting principles, and different accounting principles would allow you to use different methods. So you don't only have one method, you have various methods, and you could use estimates, starting with depreciation. And I'm going to give you a few examples to give you a feeling about this. Some companies could use the straight line method. Other companies could use the double declining method. Well, what would that do? Well, if you use the straight line versus the double declining, the book value of the asset, which is the cost minus accumulated depreciation, will be different for two different companies in the same industries that are very similar, but if they're using two different methods, one straight line, one double declining, if you are computing return on asset, they will be different. They will be different. The company that's showing more depreciation might show a higher return on asset because book value is lower, and vice versa. It doesn't mean the return on asset is better, just the numbers are showing so. So what do we have to do? In the real world, analysts will make adjustments. So if they're comparing two companies, one using the straight line, one using the double declining, they will turn the double declining into the straight line or the straight line into the double declining. Therefore, these two comparisons are comparable, those two ratios. Inventory valuation. Some companies use FIFO, some companies use LIFO, some companies use a combination of the two, some companies use specific method. Well, what's that going to do? It's going to lead to a varying cost of goods sold and inventory values. And that's going to impact all ratio that deals with inventory, all ratio that deals with profitability, because cost of goods sold goes into your profitability, mainly gross profit and eventually net profit margin, return on asset, return on equity. All these involve net income. And if cost of goods sold is affected, well, all these ratios will not be comparable unless you make, again, an adjustment. Or you basically make adjustment to the numbers, or you make some sort of an allowance. Also, allowance for bad debt. When you are reporting account receivable, it's reported net of realizable value. That allowance, account receivable minus the allowance is an estimate based on the company's judgment. Management will determine that estimate. Now, yes, the auditor would review this. Nevertheless, it's an estimate, and it differs from company to company. It differs from year to year. Warranty liabilities, warranty expense, warranty liabilities, those are estimates. Contingent liabilities, etc. So the accounting numbers, most of them are based on estimate. And what is that going to do? That's going to put a limitation on the usefulness of the ratios. It doesn't mean they become useless. And how do we overcome those limitations in the real world? Analysts will make adjustments. That's all what they have to do. There's, okay, let's assume both companies use the straight line. What would return on asset looks like, or what's the asset turnover looks like? So company A uses the straight line for depreciation, while B uses the accelerated method. Companies A ROI may appear more favorable than company B, even though both companies have similar operational efficiencies. Or the opposite could be true depending on what year of depreciation you are looking at. The point is, because we use accounting numbers, we use estimate to get to these numbers. Ratios are based on accounting numbers. Accounting number are estimate. Ratios are estimates, and that's a limitation. 2, managerial manipulation or motivation. Now, this reason is a byproduct of estimates. Now, how can managers manipulate, window dress, change, make the numbers look good? Because accounting allow you to use different accounting method, different estimate. So, but now what we're saying is, it's not only we have different estimates, different accounting method. Now we have to deal with management manipulating those numbers on purpose. It's called window dressing to make the financial statement look good. Now you might be saying, why would managers want to do that? Well, one reason is compensation. Oftentimes in big companies or publicly traded companies, managers are compensated, are rewarded. Their bonus is dependent upon the company's performance. Therefore, how can you make the company look better? Reduce cost of goods sold. How can you do that? Find the inventory method that's going to lead to the lowest cost of goods sold. Use the depreciation method that's going to give you the highest income. Use the allowance method that's going to give you the highest income. As a result, you manipulate income, you manipulate earnings per share, you manipulate the stock price, you manipulate the compensation package, especially if you're getting paid in stock options for these managers. Therefore, this manipulation undermines the reliability of ratio analysis. It's not only you have the option to do it, now you have people have every incentive to do it. For example, a manager could cut R&D, research and development. They could cut the maintenance cost on the equipment. Yes, for this year, it's going to reduce cost, it's going to increase income, but in future years, we're going to have more breakdown. So management might record inventory early or delay expenses to boost net profit margin in order to boost earnings per share. At the same time, they could artificially improve liquidity ratios by delaying payments of liabilities after the reporting period. So they could do different things, manipulating the figures by making those judgments. So another reason why you have to look at ratios very carefully is management can manipulate those ratios. And manipulation here, it's not good. It's called window dressing. It means they make it look better, manipulation, whatever you want to call it. Now, this manipulation could amount to fraud sometime. So sometimes managers would cross the line of using different accounting method or basically, pushing the envelope with their judgment. Sometimes it could lead to fraud sometimes. So you have to be careful with this. So what feeds into this is timing and temporary changes. Ratios provide a snapshot of company's financial performance at a specific point in time. When you're looking at the balance sheet is a specific point in time. It does not reflect ongoing trend. Because when you look at numbers on the balance sheet, yes, oftentimes we use the averages, but nevertheless, that's a point in time. So ratios can be influenced by timely related activities or transaction, such as last-minute transaction or adjustment made at the end of the accounting period. What are we discussing here? So a company with a quick ratio of 1.2 may decide to pay down the short-term liabilities the last day of the fiscal year. Well, if they pay it down, they will improve that quick ratio. They will improve the quick ratio, but it doesn't mean we are doing better. All what they did is they timed the transaction to make the ratio look better. Conversely, a retail company might show lower liquidity ratio during off-season despite having adequate financial health overall. So in other words, companies can time things to make those ratios look better or look worse for that matter. Also, we have accounting profit and economic profit. So when we evaluate a company, yes, we could look at ratios, but we also have economic profit that we don't use. So that's also a limitation of ratios. What is accounting profit? Accounting profit is accounting numbers, revenues minus expenses. You have to pay wages, you have to pay rent, you have to buy raw material, and you have revenues. That's the accounting profit. It ignores implicit cost. What is implicit cost? Accounting record don't show you something we called the opportunity cost of capital, which is what would you have done with this resource, time, money, whatever you have, if you did not undertake this option. This is called opportunity cost. Accounting don't capture opportunity cost. Economic profit shows opportunity cost. Therefore, economic profit is the surplus of revenues over both explicit and implicit cost. We don't consider implicit cost in accounting. We look at the strict numbers. For example, a small business owner earns $100,000 in accounting profit. Okay. However, if the implicit cost of the owner is the time, they could have earned a salary of $60,000. The economic profit is only $60 because they could have earned $60. That's the alternative, but they earn $90. So there's an opportunity. They lost $60, therefore their net profit is $40. So ratio based on accounting profit might misrepresent the firm through ability. Industry comparison and benchmark. Let's go back what we started with. And we said we always compare ratios to benchmark, whether it's the industry averages, other competitor, or prior year. The prior period could be a benchmark for us. Ratios are only meaningful when compared to industry average or competitors. We already know this. What did we say earlier? We said that different companies would use different accounting methods. Now, how can you compare two companies and you're looking at the industry averages, and these companies overall, each one of them use a different method, different operational practices and accounting method? It will make it more difficult to compare. Nevertheless, you have to have some sort of a benchmark, but you have to keep in mind that the benchmark may not be the best. So a technology and a company and a manufacturing company cannot be directly compared using a single profitability ratio, as the cost structure, revenue model, and capital intensity differ significantly. So the first thing, we already know this, you cannot compare two companies in two different industries. We already know this, but we're starting to set the ground from the big picture. Let's assume you want to look at industry-specific comparison. Well, ratios are most useful for companies operating in a single industry because industry averages now serve a relevant benchmark. Now we're looking at only specific industry. We're not comparing technology to manufacturing. Well, how about if the company that you're comparing it to is a conglomerate? What is a conglomerate? Conglomerate is a company that operates in multiple industries. For example, GE, General Electric. When you think of GE, you would think of electric, the refrigerator at your house. But GE in healthcare, GE in aerospace industry, GE in electronics, GE, it was in money lending. So it's a conglomerate. It's in many different industries. So because some companies, you think they are in one industry. Another example will be Pepsi and Coke. Now, when I teach a financial analysis class, I always ask the students to choose two companies and do their own research. And the classic example I always get is they compare PepsiCo to Coca-Cola. Yeah, well, you would think they are beverage companies. Not really. Coca-Cola is more like a beverage company, but PepsiCo is food and beverage. So sometimes you would think the companies are comparable, but when you look at the various sub-companies that this company has, they are not comparable. So a conglomerate with operation in technology, retail, and manufacturing might report a gross margin that combines the high margin typical of technology firms with lower margin of retail and manufacturing. Comparing this blended margin to an industry average would not provide a clear picture. So if you compare this company to the retail company, they might look doing better because they have technology. Or if you compare this to the manufacturing, the same thing. The technology is bringing their average higher. So you have to be careful. So industry-specific ratios should be analyzed separately for each division of the conglomerate to gain meaningful insight. Now, if you're comparing Pepsi and Coke, yeah, that's fine. You only compare the beverage division of PepsiCo and the beverage division of Coke, then they are comparable. Nevertheless, you could always find differences that you have to adjust for, but at least you will make those differences smaller. Also, size makes a difference. Now, we learn in common size financial statement that if you use percentages, size is out. Nevertheless, size affects you in other ways. So size differences between firms introduce variability in financial ratios. Why? Again, when you compare everything in differences, you can compare them from a numerical perspective, but in actuality, they are not comparable. Why? Because larger companies, they have better access to the capital market. Because they're larger, they can secure financing at a lower cost. So if a company is a multi-million or a multi-billion dollar company, they can borrow money at a lower cost than a smaller company, which would do what? Will improve their leverage ratios. Well, if you compare these ratios, taking into account the size, factoring everything as a percentage, well, you still not taking into account the true economic size of one company versus the other, because the larger have a better access. Economies of scale. Larger companies can produce more. As you produce more, your fixed cost per unit goes down. As your fixed cost per unit goes down, your profitability goes up because you are achieving lower average cost, which improve your profitability. Again, economies of scale for a larger company will have an advantage. So comparing a large and a small company, you think, but we're using percentages. They should be the same. Yes, once you use percentages, you're comparing exactly the percentages, but the economic benefit of the larger company, it's still there. Same thing with market reach. Larger companies, they operate on a larger scale, maybe in the whole country, maybe in the whole world, while smaller companies operate in one part of the country, maybe on the East Coast or only the US, but the other company operate globally. So again, the size matter. So a small regional retailer might have a higher debt to equity ratio compared to a national chain because it lacks the same access to the capital market that the other one has. Okay. Also, the national chain might benefit from bulk purchasing, improving its gross margin. A case in point is Walmart. Why Walmart is more profitable than other smaller chains like Target? Why? Because it's not more profitable. They all sell the same thing. It's because Walmart can squeeze their supplier more because they have the size, they are larger, they buy more, they buy in bulk, they force their supplier to lower their prices. As a result, Walmart can sell for less and they can take market share and profitability away from their competitors. Also, one problem with ratios is the lack of qualitative insight. Ratios are all numbers, but companies have other assets other than the actual assets, the financial asset. They have people, employee morale. Ratios don't capture that. Brand reputation. Ratios don't capture that. Innovation or market conditions. Ratios don't capture any of those. So a company might not have favorable ratios, but or a company might have favorable ratios, but they could be struggling with declining customer satisfaction. Ratios don't capture customer satisfaction. They don't capture that. But if their customer satisfaction going down, eventually it will catch up with them. But right now, ratios cannot show that. So a company with high gross margin might face lawsuit or reputational damage due to poor product quality. This risk is not reflected in the financial ratios. Now, it will be reflected in the notes, hopefully, if they would report this, but nevertheless, ratios don't show it. Inflation and currency effect. Other factors that could affect ratios are inflation and currency, specifically currency fluctuation, but they both basically follow the same thing. Currency fluctuation would distort financial data, especially for companies operating in multiple countries. If you're operating in Europe and your sales is rising is good. But when you convert your euros to the US dollar, let's assume the euro weakened and you're buying less US dollar, when you report your main financial statement in US dollar, because you have to report in the parent currency, it looks like you are selling less in Europe, while in reality you are increasing. So the financial ratios don't capture. The same thing with if you are operating in an inflationary country. A multinational company's debt to equity ratio might increase if the value of its foreign denominated liabilities rise due to the exchange rate, even though its operational performance remain unchanged. So if you are operating internationally, your debt to equity will increase if the value of the debt will go up. So if the value of the debt, why would the value of the debt goes up? Because due to exchange rate for that currency, because you have foreign denominated debt. Your debt went up, it looks like you are more risk prone because you have higher debt to equity. Well, that's not really true. It has nothing to do with what you're doing as a company. It has to do with inflation and foreign currency in that country. Also, another weakness in ratios is generalization across ratios. Ratios are not universally strong indicators of financial health. Okay? Their significance vary by industry, firm, and even division. So not all ratios carry the same weight, and not all ratios carry the same weight within the same industry or the same company, or even within the same division. For example, in a capital intensive industries, capital intensive means what? It means a lot of money to operate. You need a lot of assets, high debt to equity, because you need those assets. That might be the standard. It's a capital intensive. The same ratio in a technology startup could indicate excessive risk. Therefore, you cannot say, well, this companies, for example, the utilities companies has a high debt to equity, it's not good. Well, that's the nature of the beast. That's the nature of the beast. That's how they operate. Well, if this debt to equity high figure was in a technology startup, then it's risk. So users of ratio analysis should evaluate ratios in the context of the firm operational and industry specific norms. We're kind of saying the same thing, but it's good to look at it from a different perspective. Again, impact of mixed industry averages. Industry averages can include data from firms with diverse characteristics or even a small sample. So when you look at the average, what is this average? The average could be including many other companies that operate in areas where you don't operate in, or the average could be a very small sample that's not representative of really an average. So if we're looking at capital intensive versus labor intensive firms, these firms will differ in leverage, return on asset, and fixed cost structure, because the capital intensive, they rely on what? On their asset. Labor intensive, they rely on their labor. So when you're comparing, even though they could be in the same industry but using different strategy, well, they will differ. Ratios will not make sense. Divergent leverage policy. Some firms might adopt high leverage strategies to amplify return. So some companies, that's what they want. They like risk. They want to take on risk to amplify return. But again, this is a risky thing because you take on risk. It's a double-edged sword. Other companies in the same industries, they prefer low leverage. They want to be stable. They don't want to take a lot of risk. Although they are in the same industry, they're head-to-head competitors. They're still not comparable because different companies, they want to operate differently. So in the airline industries, large carriers may exhibit high leverage due to the significant fixed cost, while smaller regional airline might purchase equipment and might report lower leverage because they prefer to buy them, or vice versa, where the small borrow and the large buy. It doesn't matter. The point is how you operate from a leverage perspective, how you acquire your asset, whether you want to buy them upfront or you want to borrow money. It makes a difference. Although that difference, it's going to appear in ratios as wide, but in reality, that's a choice you make. Therefore, the ratios will have to be taken with a grain of salt. The last factor is earnings quality. And I believe earnings quality we should have a separate recording for earnings quality, because earnings quality, it's going to go back and revisit some of these factors, not all of them, some of these factors. So what is earnings quality? We'll look at this in the next recording. Earnings quality is an important concept in finance and accounting for management. So when you're analyzing a company, you're analyzing their earnings, their profitability. Well, how good? What's the quality of the earnings? What could factor into that earnings quality? Basically, we mentioned to a great degree the same thing that factors into the limitation, but we would look at it from a earnings quality perspective. Let's take a look at this multiple choice question from farhatlectures.com. A smaller regional retailer report a higher debt to equity ratio, so debt to equity, a higher debt to equity, it means we have more debt than equity, compared to the national retail. What is most likely explanation for this difference? So why would this difference occur? Because when you look at it just right from the get-go, it's like, oh my God, they have higher debt to equity. They must be riskier than other companies because they have higher debt to equity ratios. But there could be other explanations. So looking at the numbers, even comparing the numbers to the industry, will not make any sense unless you explain it within the context. The smaller retailer uses FIFO for inventory while the national chain uses LIFO. Well, you have to be careful. Yes, they are retail chain, they might have inventory, but debt to equity has nothing to do with FIFO and LIFO. Okay, FIFO and LIFO could affect cost of goods sold, could affect return on asset like net income, but debt to equity, we're looking at debt. So I would hold on A. The smaller retailer lacks the same access to capital as the national chain. Well, here we're working in that territory. Here we're talking about access to capital. Access to capital for what? If they lack access to capital, it means they cannot access capital as easily. They cannot have access to capital. I would say between A and B, I can definitely take A out. B is in that vicinity because capital market means borrowing money, financing yourself. So the smaller firm, the reason they have more debt because they don't have the same access as the national chain, because the national chain, they might have more access to equity, to stocks. That's a possible good answer. Let's look at C. The national chain has more seasonal sales variation than the smaller retailer. Yes, sales variation will make a difference when you're calculating ratios, but not directly affected to debt. So C is out. The smaller retail has a higher depreciation expense than the national chain. I hope you see here that there's a trend that A, C, and D, you could eliminate them for the same reason. They look at things that are not related specifically to that. Expenses affect like net income, return on equity. So you have to be careful. All these are actual differences, relevant differences. But what applies that to equity? B. One possible explanation is the smaller retailer lacks the same access of capital as the national, therefore they have more debt. They are riskier because they cannot raise equity as easily as the larger firm. What should you do now? You want to go to farhatlectures.com, look at additional multiple choice questions. That's going to help you whether you are studying for your CMA, CPA, accounting, finance. Invest in yourself. Farhat is always here to help, and of course, stay safe.